Hi, today we're going to be looking at the stock market and specifically looking at why companies offer shares of stock. What do we mean by stock? We'll talk about the primary and secondary stock markets. We'll discuss how the stock prices are determined, and we'll discuss also ways in which investors can make money by owning shares of stock. So first off, we begin by just defining what we mean by the word stock or stocks. To own stock means that you're a part owner of a company. A stock certificate says it's a piece of paper that says you own a percentage or a portion of a company. And as a stockholder, we sometimes call you a shareholder or a stockholder. And we call that stock certificate, sometimes we'll refer to it as a stock or a share because you own a portion of a company or a share of the company. We'll talk about it being called an equity, or sometimes it's called a security. So those are all just synonyms for stock. How do stocks trade? Well, we trade stocks generally on a stock market. There are two stock markets in particular that we're interested in for this class. The first market is the New York Stock Exchange, or NYSE. That's one of the largest and oldest stock exchanges in America, and that's where many companies' stocks are offered for sale and where they are traded. It's also the home of what we call the Dow Jones Industrial Average, or the Dow, which is really sort of a composite. It's looking at 30 of the largest companies and tracking how those stock prices are doing over time. So the NYSE is the home for the Dow, and the Dow deals with these 30 biggest companies that we call blue chip companies. We'll talk more about them in a different presentation. Another market we need to know about is the NASDAQ, or NASDAQ. The NASDAQ is another major stock exchange or market, and that market generally deals with technological companies. So that tends to be home for tech companies who want to offer their shares of stock to people to purchase. Regardless of what stock exchange you are trading stocks on, your activity will be managed or regulated by the Securities and Exchange Commission, or SEC, and their job is to protect investors against fraud, to make sure that when companies offer information about their performance, that investors have accurate information. And they also make sure that people who run companies do not trade their stock with information that only they have, which is called insider trading. They want to make sure that the market has all of the information available to it so that everybody who is involved has an equal opportunity to make an informed decision. And so the SEC is an important regulatory body that covers the stock market. Not every company in America offers stock. Some will choose to offer stock, some will not. Those companies that do not offer stock are called privately held companies or private companies. These are ones that do not have to report any information to the public because they're not offering shares to the public for purchase. And so they are very sort of secretive as far as their operations and their financial statements and how well are they doing as a company. That's all kept private because they don't want to share it and give up that competitive advantage. Some companies that fit into that category, companies like Mars, which is in Virginia, Enterprise, Toys R Us, Publix supermarkets, these are companies that do not offer shares of stock. The alternative is to take your company public, and then to offer your stock. And the reason companies will offer stock to the public is because they need to raise money. If companies want to raise money to do some expansion or to grow their business, they can do it by either taking out a loan, which requires them to pay back the bank plus interest and is sort of risky, or they can offer the opportunity for investors to purchase a portion of the company, and in exchange for a portion of the company, they would receive money that they could use to expand their operations. They don't have to pay that back, so it's not as risky. And so if a company chooses to go public and sell shares of stock to people outside of the company, we say that they have an initial public offering, or IPO. And the purpose of that IPO is to raise money for the company so that it can grow and continue its operations without having to take out a loan. When companies have an IPO, they will hire an investment bank to help them with that process, and that process requires a couple of steps. The first step is to produce what's called a prospectus, which is a detailed analysis of the company and provides people with information to help them make a decision about whether or not they are interested in investing in this company or not. Then they will advertise the sale to the world and let people know that they are going to be offering shares of stock and when that will happen. They will set a price that they expect to get from their shares of stock, and this is important because they want to raise a certain amount of money, and so they're going to try and make sure they earn at least that much money when they make their stock available to the public. But because they cannot guarantee the price of stock, they will get a company to underwrite the sale. That is, basically it's an insurance policy to ensure that the company gets the money that they need and the money they are looking for. And so that's what it means to be underwritten, is to basically have an insurance policy that will provide a guaranteed price for the shares of stock they're offering. Shares of stock sold through an initial public offering are sold on what's known as the primary market because it's the first time that a share of that company's stock has been sold. Anytime stock is sold on the primary market, the money that is exchanged for the share of stock goes directly to the company. After the IPO, shares of stock will go into what's called the secondary market. They've already been sold once, and now they're going to be sold a second time. When shares of stock are sold on the secondary market, the price is determined by the supply and demand of that stock. So if people feel like they want to purchase more of a company's stock, the demand will increase and so will the price. If people decide that this company is no longer worth holding ownership in because they're struggling or they're going out of business or something like that, or it looks like they might go out of business, then we'll see people want to get rid of their shares of stock. There'll be less of a demand. There'll be more people trying to get rid of their shares, and that will cause the price to go down. So the market sort of decides on a day-to-day, hour-by-hour, minute-by-minute basis what the share of stock will sell for. When those shares of stock sell on the secondary market, that money goes into the hands of the previous owner of the stock. The company itself no longer receives any money from shares of stock once the shares enter into the secondary market. So how do you make money on stocks? Well, there's two ways that you make money on stocks. One is through what are called dividends, which we'll talk about in a second, and the other is by selling your stock, hopefully for more than it was bought for. And when you sell stock for more than you paid for it, we say that you have a capital gain. We'll talk just a little bit more about that in a second. Dividends are a share of the company's earnings that are paid out to owners of the stock. That is, the company has a profit and its owners want a portion of that profit. So the company determines how much of its profit will be shared with the owners, and it is usually expressed in terms of a certain amount per share. So it could be 25 cents a share or $1 a share. And while it doesn't seem like a lot of money to get a 17-cent per share dividend, if you own 10,000 shares of the company, then that adds up to some serious money. So the dividend is going to be determined based on the number of shares that you hold times the price that's been determined by the company, and that will say to determine how much you receive in dividend payments. And those payments can be paid out on a quarterly or annual basis. So in this example, you hold 250 shares. If it's a quarter per share in dividends, then you would receive 250 times 0.25, that's $62.50 every quarter in dividend payments. That's just free money to you as an owner of the company. Not every company will offer dividends, and not every company will offer the same amount for dividends. But when companies do offer them, it is a way for you to make money. The other way to make money is to sell off your stock. That is to give somebody else ownership in the company and take their money in exchange. When you do that, the old adage is to buy low and sell high. That is, try and buy stock at a cheap price and then sell it when it's very expensive. There's no way to guarantee that, but that's sort of the goal. When you sell your stock for more than you paid for it, you receive what's called a capital gain. It's a profit, and that profit has a term called capital gain. So if you bought your stock for $100, sell it for $150, that difference of $50 on that share of stock is referred to as your capital gain. If, on the other hand, you sell for less than what you paid for it, then you would say that you have a capital loss. But sometimes it's better to take a small loss than to let the value of your stock continue to fall and take an even bigger loss over time. So Those are the main ways in which we can actually earn money and increase our wealth by owning stocks, through the sale of stocks in a capital gain or by receiving dividends. We'll talk more about the different types of stock that you can own and how you can put together a portfolio in another video.